The supply is effectively dried up. On November 27th, the CME suddenly stopped silver trading in the middle of the session. They blamed it on a cooling issue, a simple technical malfunction. But experienced traders understand that moves like this rarely happen without deeper problems behind the scenes. According to industry chatter, several of the world's largest banks may have sold around 250 million ounces of silver that they never actually had in their possession. Now, someone appears to be asking for physical delivery, and the system is straining under the pressure. Over the next 11 minutes, the picture becomes clearer. Bank of America recently suggested that silver could reach $65, but that estimate may be far too low once you see what is unfolding. Silver is becoming harder to find in the real world, and the signs are everywhere. By December 4th, the price hovered near 59 to 65, a record high, and represented roughly a 101% increase in a single year. Compared to that, gold rose about 60%, and the S&P 500 gained around 15%. Silver didn't inch forward, it leapt. Only one other year in modern history has shown a move like this, 1979, when silver skyrocketed by roughly 435%. But that surge was fueled by the Hunt brothers' attempt to corner the market, which eventually collapsed. What's happening now is not a manufactured squeeze. It's a math problem the market can no longer ignore, an imbalance between what exists on paper and what exists in physical vaults. Recent data shows just how intense the pressure has become. Inflows into silver funds in November alone reached nearly 15.7 million ounces, more than the entire amount seen across all of 2024. These inflows have occurred in 9 of the past 11 months, a pattern that doesn't match the behavior of casual retail buyers chasing a trend. This is strategic accumulation, and it suggests that large players, industries, institutions, and perhaps even governments are preparing for a shortage. The reality is simple. When the world's most crucial industrial metal begins to disappear from inventories, everything changes. Banks may be tangled in commitments they can't fulfill. Major sectors may be scrambling to secure whatever supply is left. And the next 30 days could bring several major catalysts that push prices far beyond the conservative $70 mark that analysts quietly reference. The market isn't reacting to hype. It's reacting to scarcity. And when scarcity hits something as essential as silver, the consequences ripple across everything from technology to energy to global finance. Institutional investors, pension funds, sovereign wealth funds, and other major players who move billions quietly seem to have begun accumulating silver about 9 months ago. These are not emotional traders chasing headlines. They act early, they act silently, and they act on information the public rarely sees. So the real question becomes, what did they notice back in March that never reached mainstream coverage? What reports landed on their desks that signaled a shift long before ordinary investors caught on? Current estimates suggest that total silver ETF holdings have reached roughly 1.13 billion ounces, valued at around $40 billion, supposedly the highest level ever recorded. The last time holdings approached anything like this was in 1979. Just before the Hunt brothers' attempt to corner the market pushed silver to nearly $50 and sent shockwaves through the entire commodity sector. Recognizing repeating patterns is not paranoia, it's caution. And the pattern emerging today feels unmistakably urgent. While most investors focused on stocks and the rise of crypto, trouble appears to have been building in the physical silver market. The London Bullion Market Association, one of the most influential institutions in global precious metals trading, used a phrase in November that should have dominated news headlines: state of seizure. That isn't typical market language. It suggests a system under extreme stress, a mechanism locking up, a market struggling to function. This was not the description of a mildly tight supply environment. It implied something closer to a freeze. Supporting this concern is the surge in lease rates, the cost of borrowing silver for short periods. These rates reportedly jumped to about 39% annualized. For context, that's the kind of interest rate usually associated with high-risk credit card debt, not short-term metal loans. No bank willingly pays that unless they're desperate to source metal quickly. Why would they be desperate? Because they may have obligations to deliver silver that they no longer physically possess, relying instead on futures, derivatives, or other paper promises. Now someone seems to be demanding the real thing, and those promises are being tested. Market data indicates that back in 2021, the COMEX held about 130 million ounces of registered silver. Today, that number appears to have fallen below 30 million, a drop of roughly 78% in just 4 years. Meanwhile, industrial users burn through an estimated 700 million ounces annually. That means the current available supply in COMEX would last industries only about 2 weeks. 2 weeks of real-world usage in sectors that rely heavily on silver for electronics, solar energy, medical technologies, and countless other essential applications. Then came that Friday. Silver was climbing fast around the mid-50s when the price suddenly spiked and trading abruptly stopped. This isn't the first time markets have frozen when major players were caught off guard. It happened during the GameStop squeeze when hedge funds were exposed. It happened in 2022 when a large short position in the nickel market triggered chaos. And now it seems silver may be facing the same problem. Paper instruments can be controlled for a time, exchanges can halt trading, statements can be issued, but physical silver cannot be manufactured on demand. It cannot be printed, inflated, or created out of thin air. When paper claims collide with actual scarcity, the physical market always wins. The reason this situation appears so difficult to stop comes down to one issue: a structural deficit. Silver has reportedly been in deficit for 5 straight years, meaning that every year, demand exceeds the available supply. The deficits of 2021, 2022, 2023, and 2024 have now led to a projected deficit between 149 and 215 million ounces in 2025. Under normal circumstances, higher prices would encourage miners to increase production, gradually balancing the market. That's the classic economic model. But silver doesn't follow that pattern easily. Industry sources explain why. It typically takes 10 to 15 years to bring a new silver mine into full production. From early exploration to rigorous environmental permits to construction and final output, a decade is considered fast. This long timeline means the market cannot simply react overnight. Even if prices skyrocket, there is no immediate way to produce significantly more silver. The gap between supply and demand continues to widen, and the pressure continues to build. When you pull all the evidence together, record ETF holdings, steady institutional accumulation, shrinking global inventories, soaring lease rates, sudden trading halts, and half a decade of persistent supply deficits, it becomes almost impossible to dismiss what's happening. The physical silver market appears to be under significant strain, and the forces driving that strain are long-term, structural, and not easily reversed. The last major silver mine to come online began production around 2019, roughly 6 years ago. Throughout the 2010s, silver prices stayed trapped in a narrow range between about $15 and $25. At those levels, mining companies had no financial incentive to develop new projects. Banks weren't willing to fund multi-billion-dollar operations with thin margins. As a result, exploration stalled, proposed mines were shelved, and global production stagnated. Now, even with prices near $60, those long-delayed projects are still an estimated 8 to 10 years from becoming operational. That is the nature of the mining industry. Environmental reviews don't accelerate because the price chart turns vertical. Local opposition doesn't suddenly disappear, and government approvals do not magically speed up. In practical terms, silver supply is locked in place until at least 2032. At the same time, demand is not just increasing, it's accelerating. Solar panel installations are doubling, electric vehicle production is tripling, and the infrastructure needed to power artificial intelligence continues expanding at a rapid pace. What makes this especially important is that this demand is not discretionary. It isn't based on consumer preference or the ebb and flow of economic cycles. It is legally mandated. The U.S. Inflation Reduction Act requires massive growth in solar and renewable energy capacity. Europe's Green Deal enforces strict renewable targets for its member countries. China, already the largest solar producer in the world, is installing panels faster than every other nation combined. These aren't flexible guidelines or voluntary commitments. They are legal obligations backed by subsidies, tax credits, industrial penalties, and government enforcement. That means solar manufacturers must secure silver, no matter what it costs. If they fail to purchase it, they violate contracts, lose access to subsidies, disrupt construction timelines, and invite legal trouble. The demand is binding, contractual, government-backed, and unstoppable. Meanwhile, supply appears to be fixed for nearly a decade. Now add another critical factor: the Federal Reserve. The Fed meets next week, and markets are reportedly assigning close to an 89% probability of a quarter-point rate cut. This matters because precious metals typically move in the opposite direction of real interest rates. When rates fall, the dollar tends to weaken. When the dollar weakens, dollar-priced commodities often climb. The relationship is mechanical. There is also increasing discussion about Kevin Hassett, former economic advisor under President Trump, being considered for the role of Fed chair. Hassett is widely regarded as a monetary dove, someone who favors faster rate cuts and more stimulus. If the Fed pivots more aggressively under that leadership, the dollar's purchasing power could erode further. And historically, when a currency weakens, investors move toward hard assets: gold, silver, real estate, and key commodities. To understand how this dynamic can play out, look at palladium in 2020. Few people outside the auto industry paid attention to it. Palladium is essential for catalytic converters. There is no substitute for its functionality. For years, supply and demand were stable. Small deficits appeared, but nothing severe. Then COVID hit. Mines shut down. Logistics networks collapsed. Automakers suddenly couldn't secure the palladium they needed. Prices climbed from around $2,000 an ounce in early 2020 to over $2,900 by March 2021, an increase of roughly 45% in a single year. And here's the revealing part. Even after mines reopened and supply chains returned to normal, prices stayed high because the structural gap between what the world needed and what the world could produce remained unresolved. Silver today stands in a similar position to palladium in 2020, except amplified in every direction. Supply is tighter, demand is mandated rather than optional, global inventories are shrinking, and the monetary environment is shifting toward conditions that historically push precious metals higher. When pressures like these collide, Markets do not inch upward. They leap. They rewrite expectations. They form new baselines that rarely return to where they began. The reason is simple. Once industrial buyers lose confidence in the reliability of their supply chain, they don't wait for the problem to fix itself. They act aggressively. They overbuy. They stockpile. They secure multi-year contracts at any price just to guarantee production. This fear-driven behavior fuels the very shortage they're trying to avoid. That's exactly why palladium never returned to $2,000 after the 2020 shock. Even after mines reopened, the market simply reset at a higher normal, around $2,400 to $2,600, because buyers no longer trusted the system enough to let inventories run low again. Now apply that same pattern to silver, but on a much larger scale. We're talking about 5 consecutive annual deficits. Solar panels consuming an estimated 350 million ounces per year. Electric vehicles requiring silver for circuitry. AI infrastructure demanding even more. And militaries relying on silver for everything from guidance systems to advanced communications. Unlike other metals, there are no meaningful substitutes for silver's conductivity and performance. The pattern is the same as palladium, but the scale is exponentially larger. This brings us back to Bank of America. In October 2025, they released a report projecting that silver could reach roughly $65 per ounce in 2026, with an average around $56.25. Bank of America is not known for sensational forecasts. They are among the most cautious and conservative institutions on Wall Street, so for them to issue a target that bold suggests their analysts saw something that made restraint impossible. They saw the deficits. They saw inventories collapsing. They saw rigid, inelastic industrial demand. But they also saw another factor just as important: capital flows. When major banks publish bullish targets, it's often because their clients, pension funds, sovereign wealth funds, endowments, are already reallocating capital. These reports don't just predict, they justify. They provide institutional investors with a narrative that supports larger positions. See? Bank of America projects $65. We're not taking a risky bet. We're acting responsibly. Once that justification is in place, allocations increase, demand accelerates, and supply pressure grows even more intense. Then Citi reportedly followed with a $62 target within 3 months. UBS came next, then HSBC. This is not the slow development of consensus. It looks more like the beginning of a stampede. And stampedes, once triggered, do not stop just because the price reaches a round number. Solar manufacturers won't pause production if silver hits $80. They'll simply pay the price. EV producers won't halt assembly lines if silver reaches $100. They'll write the check. These industries have no alternative. Their demand is locked in by law, contracts, and national policy. So the real question becomes, how high must prices go to ration the available supply? Is the threshold $70, $90, $120? No one knows because we're moving through conditions the market has never faced before. But history shows what typically happens in moments like this. Fortunes are made, and someone gets crushed. Every severe supply shock ends in pain for one group or another. Either the traders who sold metal they didn't have get forced into buying at any price, or the manufacturers who desperately need silver find themselves unable to secure enough to keep production lines running, or the investors who waited too long miss the move entirely. Squeezes do not resolve neatly. They break something. If Bank of America's forecast is correct and silver reaches $65, By 2026, that's only about a 10% gain from current levels. Solid, but not transformational. But what if they're not just being cautious? What if $65 is only the first stage of a much larger repricing? What if the true surge begins when industrial buyers realize COMEX inventories are nearly empty and start locking in supply at any cost? What happens if the market goes bid only? No sellers, only buyers. We've seen this pattern play out before. In 2022, nickel exploded from roughly $20,000 per ton to nearly $100,000 in just 48 hours because one major trader was caught short and suddenly had to deliver metal they didn't possess. That single imbalance, one forced buyer in a tight market, rewrote the price of an entire global commodity. Silver's market is larger and more liquid, but the underlying mechanics are remarkably similar. And today, many of the same signals that preceded the nickel shock appear to be flashing across the silver landscape. Only this time, the scale is wider, the stakes are higher, and the pressure points are more interconnected across the global economy. Backwardation, where the spot price trades above the futures price, is a classic sign of stress in a physical market. It suggests buyers want metal now, not later. Lease rates surging to extreme levels indicate that banks and institutions may be scrambling to borrow silver because the metal simply isn't available in the quantities they need. Inventories across multiple exchanges appear to be thinning. Trading halts have already occurred. These are not routine fluctuations. They are potential endgame signals in the early stages of a squeeze. But moments like this also create rare windows of opportunity. When you understand the structure of what's unfolding, you can position yourself not as a gambler chasing momentum, but as someone who recognizes value before the broader market wakes up. Silver at $60 might seem high today, but that perspective shifts quickly when the supply situation tightens further. If prices climb to $80, that level will begin to look reasonable. If they push toward $120, $80 will seem cheap in hindsight. In a true supply shock, the question stops being, what is the price? And becomes, is there any supply at all? Right now, availability appears to be the real pressure point. Those who positioned around $30, roughly 6 months ago, are already up close to 100%. Those entering the market around current levels might still capture another 50% to 100% potential upside if these pressures continue to build. But those who wait until mainstream news outlets run silver mania headlines will likely be arriving at the final stage of the move, the point where smart money is preparing to exit and late money rushes in as exit liquidity. There are 3 catalysts unfolding within the next 30 days that could accelerate this entire situation. First is the Federal Reserve's rate decision on December 18th, with markets reportedly pricing in an approximately 89% probability of a cut. Lower rates weaken the dollar, which historically strengthens precious metals. Second is the January options expiration on the COMEX, which could force physical delivery if short positions can't be covered with metal. Third is the seasonal surge in Asian demand surrounding Chinese New Year in late January, a period when buying typically spikes by around 40%. 3 events, 30 days, and an estimated 30 million ounces of available supply. Conditions that could produce dramatic volatility. This is why tracking the data matters. Silver at $60 may not be the end of the story. It may be the opening chapter of a broader shift in how markets value hard assets in a world shaped by aggressive monetary policy. It may signal a turning point in how scarcity is understood once old assumptions about endless supply begin to fail. It may mark a shift in economic power as the commodities we rely on tighten and nations, institutions, and industries compete for what's left. In the next video, the focus will be on the exact inventory tripwires worth watching, critical levels that reveal whether this is a normal bull market or the early phase of a full-blown mania. The difference matters because understanding that distinction can determine whether you walk away with profit or end up holding risk at the worst possible moment. Subscribe not because of hype, but because mainstream coverage typically arrives long after the opportunity is passed. They will report on silver when it hits $100, when the banks have repositioned, when institutional buyers have already filled their quotas. You don't want to be the person reacting to that moment. You want to be the person who saw the signs early, understood the fundamentals, and made decisions based on data instead of headlines. Silver recently hit approximately $59.65. The available supply appears to be disappearing. Bank of America projects $65, but the physical market may be sending a much louder message. It suggests that $65 might only be the warm-up, and anyone watching the signals closely can see what may come next.